Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome. My name is Bryce, and today we're looking at some of the companies that haven't recovered since COVID. We have another Pimp My Portfolio and a community question on gold. To chat through it, as always, is my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. A lot to cover, as you've just mentioned, but we have to start the top of the show with a valet to one of the best to ever do it. Jim Simons died last week as we record, aged 86. For people who are unfamiliar with Jim Simons, he founded Renaissance Technologies. Renaissance Technologies?
Renaissance?
I've only ever read it, to be honest. And Warren Buffett, I think, goes down as history's greatest investor for the amount of money created for people that invested with him. Jim Simons would be second probably in terms of amount of wealth created. But in terms of annual returns, it's Simons, then Daylight.
Yeah, he has absolutely killed it.
Yeah.
So his main fund is the Medallion Fund. It's returned a whopping 66.1% per year for 30 years.
Yes, yeah.
From 1988 to 2018. To put that into perspective, Buffett is lauded with, roughly just over 20% per year.
Yeah.
Mind you, that's been over a bit longer than 30 years.
Yeah, since 1965.
Yeah,
so 60
call
years.
it 60
Yeah.
years. So double the length, which is still outstanding. But the Medallion Fund, 66% for 30 years.
Yeah, he created about $100 billion in wealth is sort of the number. So, yeah, it's pretty amazing. Now, the Medallion Fund was only open to employees and people, friends of the fund, but it was an incredible performer. 66.1% before fees, 39% after fees. So they took a big whack of fees, but when you're delivering that level of performance, you can do that. But the thing that Simons is known for is he's known as the man that solved the market. There's a good book on him. But he started the quant revolution.
Yes.
And what we mean by quant revolution is using high computing power, using algorithmic trading to try and identify sort of correlations or mispricing opportunities or, where the market's going to go or where a particular stock or commodity is going to go, and then basically setting up the trading parameters with your computer and then going. Now, according to an estimate from the New York Times, 1/3 of Wall Street trading operations are now quant.
Wow.
And so he really sparked a movement that has transformed Wall Street, transformed the investing landscape.
Wow.
Yeah.
Well, he was a mathematician, which has led to this, which led to that.
Yeah.
Yeah, so good on him.
So the final takeaway from Jim Simons' life, it's never too late for your second act.
Okay.
So as you said, he was a mathematician. He got his PhD in maths from UC Berkeley at 23 years old. And then for 17 years, he was an academic. He was a maths professor. For about 10 years, he was the chair of mathematics at Stony Brook University in New York. And then at aged 40, he decided he wanted to see if he could make some money, and he started Renaissance. And it was about 5 or 10 years later that he opened the Medallion Fund.
Yeah.
So if you feel like you're too late in this game, if you feel like that you've missed your opportunity, take a leaf from Jim Simons' book. It's never too late for your second
We can
act.
all generate $100 billion plus in capital.
In 30 years.
Yes. No, it's an amazing story. Highly recommend doing a bit of Wikipediaing or reading the book that he's written, because it is incredible what he's been able to achieve and the contribution he made to Wall Street. So sad to see him go. Big year of losses in the investment world.
Yes,
Yeah.
yeah. Now, Bryce, last week we spoke about some of the stocks we wished we bought in 2022, some of the tech stocks, really well-known companies that we all use, that fell a lot and then have rebounded.
Yeah.
You know, Spotify, Shopify.
Yeah.
Snap. You wanted to then do a reply, I guess. You wanted to say...
This is like the rap feud between Drake and Kendrick.
Nice.
I know.
You wanted to do the stocks that haven't recovered.
Yeah, well, it made me think that we lived through that period during COVID where stocks just went crazy, and there were a number in there, well-known companies that we all use that I'm sure a lot of us thought about getting on, and it was a moment where people were saying the world's changed forever, working from home, we're never going to use the same tools and software and resources in the same way.
Yeah, e-commerce has changed behaviour.
Changed behaviour. Business flights are done. Travel gone. So that led to investing behaviour, and some stocks really ran. And so I thought it would be a good response to look at some of the companies that were the biggest winners of 2020 that have subsequently not recovered.
Okay.
And
much like Kendrick, I'm going to reply to some of yours.
Sure. So just to put it into context, there was a Financial Times article that said $1.5 trillion has been wiped from the market cap of the top 50 tech stocks that ran up during COVID. And I've got some of them here because they've subsequently just absolutely bombed. And so I think one of the key takeaways here is the lockdown trends that we thought were going to last forever have not. But Ren, here are some of the 7 biggest winners of 2020 that have fallen away. So these numbers are the percentage increase in stock price during that 2020. Should note that some of them ran a lot further into 2021.
2021 was a bigger year for a lot of these companies.
Yeah, it was just inconsistent for some, but you can guarantee that all of these ran in 2020.
Okay.
And then subsequently, we'll look at the percentage change since the end of 2020.
Yeah.
So Tesla. Mind you, Tesla was a company that probably had more than just the COVID.
Is this a caveat segment?
No. Well, okay. Because Tesla wasn't really a COVID stock for COVID reasons.
Then why did you put it first?
Because it ran hard. So it ran 787% in 2020. It's down 42% since the end of 2020.
Yeah, I was surprised you put this one first because Tesla entered 2020 at $30 a share and is now $170 a share.
Yeah.
So it didn't fall, like it's recovered.
It's recovered, but it's well down from its...
Yeah, it got to $400.
Yeah, it's down from its... euphoric heights.
Yes.
But it wasn't really a COVID stock. It was in 2020. It delivered 500,000 cars, launched the Model Y, and there were sort of business reasons for the run up. Zoom, though, the working from home, meetings changed forever. It ran 765%. It's down 80% since then, wiping $77 billion in market cap. Moderna, the vaccine provider, it ran hard, 453%. However, 453% in 2020. Into 2021, it ended up actually running 2,200%. So it went nuts. It's down 73%.
And now the vaccine makers have stopped making the vaccines. I think AstraZeneca has come out and said we're not going to make the COVID vaccine anymore.
Really?
Yeah.
What the hell?
I think they're just like, there's so much out there. It's like, we're done.
Okay.
So it's really come off.
That's gone.
Yeah.
That happened quickly.
Well, yeah,
4
COVID happened
years.
quickly.
So does that mean anyway, that's going to go down a rabbit hole, but we don't need to keep getting...
No, I think there are still... They're just saying like...
quantity.
I think they're saying like Moderna and Pfizer. Like everyone's doing it.
Gotcha. So they're down 73%. Peloton, the thesis here was we're going to be exercising indoors digitally forever.
We're not going back to the gym.
Now gyms are done. It ran 395%. It's down 97.35%.
Unbelievable.
It's now $4.
Yeah, unbelievable.
Yeah. Oh my God. Etsy, get this. 10% of revenue during 2020 and 2021 for Etsy came from selling face masks.
Yeah.
10% of revenue. So it ran 290%. It's down 78%. E-commerce, all of that sort of stuff.
Feels like that one probably has a second, like another act in it. Like that whole like long tail of
I'm sure all of
crafts.
these companies hope they have another act in it.
Yeah, I mean, Peloton.
Peloton,
I mean,
no.
apparently the bikes are good.
They are. I've tried one.
Okay.
They're not bad, but yeah. Twilio up 253%. It's down 83%.
That one's weird. Like
It
that's
is weird,
that's
yeah.
like a core part of a lot of companies' tech stacks
Yeah.
these days. Twilio, for people who are unfamiliar, is if you're ever getting like text notifications from companies or even a lot of push notifications from companies, chances are it's powered by Twilio.
Yeah.
There's no
yeah.
reason that was specifically COVID.
Yeah, it's weird. Anyway, it hasn't recovered. And then similar to Zoom, but a lot of businesses were in that sort of business collaboration. So you think, Atlassian and whatnot. There's a company called Ring Central, when researching this, constantly popped up. It ran 162%, not as hard as some of the others, but it's down 92% since the end of COVID. So look, 7 companies that at the time everyone was quite euphoric about and really jumping on the lockdown COVID trend. Those trends haven't played out and these companies haven't recovered.
So what's the takeaway here?
The takeaway, I think everyone overestimated and completely just became a little bit blind to how COVID was going to affect the way we live.
Yeah, because like I would say that if you marry the two segments up, like the well-known companies that we wish we bought in 2022 and then this, like there's a lot of overlap, because the same conversation that was happening with Zoom and Peloton was happening with Shopify. But where Zoom and Peloton haven't come back, Shopify has. And so I guess the takeaway is, like, at the end of the day, business quality matters more
Definitely,
than what's happening. Even if it's like a once in a generation thing like COVID, it's like Shopify, not to say Zoom and Peloton aren't good businesses and good tech. It's just like the business fundamentals, like what problem are you solving? How much value are you creating, and how much value can you extract from that is better with Shopify than it is with Zoom and Peloton.
Absolutely.
And at the end of the day, that's what matters.
Yeah.
This is Pimp My Portfolio. Pimp My Portfolio.
Oh, that's right. It is that time of the episode where we bring in an expert, we bring in a community member to get their portfolio pimped, and we're excited to have Mick join us today. Mick, welcome.
Thank you very much for having me. Excited to be here.
And we have in the studio a new expert to help us through this Pimp My Portfolio today. It is none other than Adam Dawes. Dawesy, welcome.
It's great to be here, guys. Great to be here.
Yes, we're very excited for this. So, Ren, to kick things off, we've got, let's give the audience an idea of what's in Mick's portfolio.
Yeah, so, I mean, the headline on Mick's portfolio is a big weighting to Bitcoin. About 2/3 of the portfolio is Bitcoin, so bullish there. And then then we've got a number of individual stock holdings, I think 8 in total. Ordinate, Alligator Energy, Boss Energy, Duratec, Elevate Uranium, IPD Group, LaserBond, Silex Systems, and Telix Pharmaceuticals. So some names that we've spoken about on the show, some that we haven't. So, Dawsy, I guess, where do you want to start? Overall impressions?
Well, Mick, we'll call this the Boss portfolio.
Oh, wow.
Because it does have the Boss energy in there, so I think that's a good starting point. But Mick, what's your sort of philosophy around this portfolio, and how did it sort of come about?
Well, I have to kind of admit the Bitcoin holdings is probably even a little bit more, I guess, degenerate than that. It's Ethereum and a whole heap of altcoins. So I started investing in that. I might have got it a little bit backwards, I think. I started with crypto, and a friend of mine used to give me a fair bit of stick about the crypto side of things, and he got me into, I guess, more grown-up equities, and I really enjoyed that side of things. I started, I guess, with some of your bigger names. I had BHP in there and I had Rio, but I think I've gone down a bit more the growth side of things, and I guess maybe the crypto history that I've had has led me to maybe take a little bit more risk on board, I guess, and want to see the growth and the gains.
It's okay, Mick. You can say you love a specky.
Yeah, I do, and I do get sucked into the odd story stock. I know that, and I know that there's one in particular that might fit that bill. But yeah, I don't mind a little bit of risk reward, I guess. It's going okay at the moment, but I know things can turn around really, really quickly, and that's part of the reason why I submitted the portfolio, is to just get some thoughts around what I've got and what's happened and what I could possibly do with it in the future.
No, totally understandable. And obviously you're quite a uranium bull with all of the uranium stocks in there.
Yeah, I guess through social media, I heard a bit about a supply and demand shortfall, and it sort of seems a bit like a long-range crypto cycle, just played out over many, many years, not shorter like a crypto one, but yeah, I just got into it that way and analysed some companies and thought I'd have a bit of a crack at them.
Yeah, so obviously there's the uranium side of things. I think you're doing okay, and Ordinate's a fantastic business, so you definitely want to keep that in the portfolio. That audio and digital disruption business, I think, is fantastic. Certainly, some of those uranium stocks you've got to be a little bit careful of because they are explorers. So you need to have an idea of how much, one, about where they're exploring management, and then getting an understanding of the business as well. So that can be a little bit tough when you're in the small cap space. Certainly Alligator Energy in that Boss Energy, look, is probably one of those good ones out there for it. And Elevate Uranium I hadn't heard too much about as well. I do like the IPG or the IPD group. I think that's a fantastic business. Electronic cable management as well as vehicle charging stations. I think that is something that you definitely want to keep in the portfolio. And Silex has had a bit of a checkered history, but still that technology is very, very good as well. So, if you were looking to sort of broaden the portfolio out, yes, you had some BHP and some Rio. There's nothing wrong with having some of the, can we call them boomer stocks?
Yeah.
Yeah. All right, we're going to call them boomers. There's nothing wrong with having those kinds of stocks in the portfolio, because you want companies that are generating revenue, making money and paying dividends for the longer term. So those kinds of things. And the speculative side of it, you can have a portion of your portfolio in there. But since this is a segment about pimping up the portfolio or pimping the portfolio, getting it more, you would definitely look to add some financials into the business, into the portfolio, because it's very resource centric. Now, our market's 62% resources, so it's very hard not to be playing in that resource space. I think uranium as a whole is a fantastic area, because we are looking for energy transition, and uranium is probably the only one with the cleanest energy that can have baseload power 24/7. So I think you're in the right space, but you just got to be a little bit careful with some of those explorers in there. So I'd definitely look for some more sort of financials in the portfolio, and then I'd definitely look to just sort of broaden the portfolio out. Generally, we'd like to have some international stocks in the portfolio. The Australian market is only 2% of the global index. That means there's 98% of opportunities that are outside of Australia. So looking at some ETFs to broaden out that portfolio, staying in the tech space, the NASDAQ 100, the IVV, which is the S&P 500, those kinds of things, to broaden out that international exposure. And that's what, over the last 6 months, you would have gotten an uplift of 30% in your portfolio if you had some international stocks in there. So you can't ignore having international flavour, because Australians, we consistently have portfolios that are very much Australian centric, and we love that, but we need to have international exposure in there. And so using ETFs in the marketplace, you can actually then build out a fantastic portfolio going forward. So financials are always good. Now, banks, they seem boring, but they pay good. That's good money there, good dividends, and there's some interesting financial stocks like Macquarie Group. Fantastic. When markets are running hot, Macquarie will do very, very well. And the other side of it is, I want you to get some more international exposure in the portfolio.
I love that.
Yeah, I've certainly been looking at some US stocks, but I just found it way too hard to do what I've done with the ASX listed stuff, because you can I know where to go to find some of the information and listen to different podcasts and different things like that, like Equity Mates. But I think the ETFs for international would make it a lot easier for me.
Absolutely. You want a basket of goods, and then what you do is you look to the different subsects. So you've got Asia, you've got Europe, you've got America,
right,
and you can pick those kinds of things. And then if you want to go high growth, like the NVIDIAs of the world, the Microsofts of the world, take advantage of the AI. There's a couple, IOO, there's a NASDAQ 100 as well. They're all going to have those tech stocks in there, and there's still a lot of growth to be had in that AI space.
Okay, nice.
I love this, Dawesy. I think listening along, Mick, how I'd sum it up is the speckies that you've got are certainly interesting,
Yes.
and now the job to be done is to build a portfolio around the speckies.
Correct.
It's interesting companies, and I think some good advice there, Dawesy. So a big thank you for joining us, and Mick, a big thank you for sharing your portfolio and letting us have a chat about it. Hopefully some of this helped.
Yeah, no, of course. I think the first thing I'll be doing is just, exploring and doing my own research on some of the international ETFs. That really appeals to me. So I appreciate you having me on.
No worries, Mick. We'll have a great day and, all the best with it.
Thanks so much. Have a good day.
Well, if you'd like to submit your Pimp My Portfolio, head to equitymates.com/contact. Similarly, if you'd like to get in touch with Adam, head to equitymates.com/advice, and we'll be able to connect you and you can get your portfolio pimped with Adam, plus much, much more investment advice. So, Adam, we'll leave it there. Thank you very much.
It's great to be here. Thanks.
This is Pimp My Portfolio. Pimp My Portfolio.
We're going to take a quick break, and on the other side, we're going to be back with a community question about the role that gold can play in a portfolio. We'll be right back. Welcome back to Equity Mates. It is a big show, a lot of news we're covering, and if you want to stay up to date with business and market news, make sure you are subscribed to our Equity Mates newsletter. It goes out twice a week, and we have key headlines, answers to community questions from experts, as well as what we are reading throughout the week.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, friend. I've got a question.
Answered.
But Ren, we have a community question that has come in from Daniel.
Yeah, that's right. We love getting these questions, so keep sending them in, equitymates.com/contact. This one is about gold. So Daniel writes, I keep reading gold is safe and can help my portfolio when stocks are down. What I don't understand is how. Should I be rebalancing my portfolio in these times with returns from gold? Or does it just make you feel better about your losses? Does it only help when you rely on an income and doesn't really affect long-term growth seekers? So a few different aspects to that question there. So we thought this was a good opportunity to just talk about gold generally and answer some of those questions as we go.
Well, let's start with the basics of gold as an investable asset, because there's no doubt that it's had a pretty decent run. Pretty consistent run,
It's
I
had a
should
pretty
say.
decent run for literally thousands of years.
Yeah.
Like, that's the thing with gold. It's like, it's been a store of value literally through empires.
Everything.
Through
Yeah.
epochs of human history.
Yeah.
But we pulled some numbers from 1971 when Nixon removed the US from the gold standard. Then the price of gold was $43 an ounce. It's now about $1,500 an ounce. That works out to be a compound annual growth rate of just shy of 8%.
Not bad.
So, like, gold has been a pretty consistent performer. And that's really why people will include it in their portfolios.
Yeah. So let's speak about the role of gold in portfolios. And it always starts with, and this is why people talk about, it's a good idea to have some level of exposure. It's because gold historically has been counter-cyclical, meaning that it's been used to provide mitigation during times where there's market stress. Counter-cyclical essentially means it moves in the opposite direction to stock markets, historically.
Yeah. So that's the first reason. And then the second reason is it's seen as a hedge against inflation. And so, that's the whole store of value that both as prices rise, gold will generally rise with it. And as currencies get devalued, gold will hold its value. And so the idea is that gold preserves your purchasing power. And so that's sort of where it sits in a portfolio. So State Street, the big financial institution, did some analysis. Now, this is from the US, But since the 1970s, during periods where the annual rate of inflation has been below 2%, the gold price has risen at an average rate of 7.8% a year. So not bad, not bad. But where gold really shines is in periods where there's high inflation. So when inflation was above 5% a year, gold has increased by an average annual rate of 16.2%.
Wow.
And that's because, you know, the price has risen, but then it also, as inflation is high, gold is obviously getting that inflation kick as well.
Yeah.
So that's really the two reasons you have it in the portfolio.
So then let's address Daniel's questions with how individuals can use it in your portfolio. So he wanted to understand how and why it helps when his stocks are down, and then also around rebalancing. So most model portfolios have a general allocation of roughly 5% to gold, if they have one at all.
If they have one at all.
Meaning they don't say 1%, 2%. It's roughly, if we're going to have gold in the portfolio, it's generally about 5%.
Yeah, yeah. But you'll find a lot of model portfolios don't have gold.
Yeah.
And that's just a choice that you make. But yeah, it's not like you're not going to find a model portfolio with 50% gold.
No.
Yeah.
No. So that's the first thing, Daniel, when you're thinking about how much gold to put in your portfolio. The second reason around how it makes your portfolio better with gold in it is that when the market falls, simply a portfolio with gold in it should fall less is the crux of it. We've spoken about how it's counter-cyclical. So when your stocks are falling and gold is going up, or at least holding its value, your portfolio is going to fall less. We're not saying your portfolio is going to stay where it is or go up, primarily because you've got a small allocation to gold, but it's just going to fall less.
And then I guess to answer Daniel's question about the how, and he asked, do you rebalance your portfolio or does it just make you feel better about your losses? It's certainly not just a psychological here to make you feel better, but it's more, let's say the market falls meaningfully and gold rises a little bit. And as a portfolio weight, gold was 5%, but it becomes 10% of your portfolio. At that point, you can rebalance and you can sell some of that gold and buy equities. And in theory, then you've been protected as the market has crashed because gold has been counter-cyclical, so your portfolio hasn't fallen as much. But then also you can take that opportunity to rebalance and buy some equities at the bottom of the market before it rebounds. So that's the theory about where gold can sort of play a counter-cyclical role in your portfolio.
I don't have any gold in my portfolio. I used to. I think I had about 4%, but I sold out.
Yeah, I am the same. I used to. Gold matters if you care about year-to-year portfolio performance, if you want to minimize volatility and if you measure risk by the volatility of a portfolio. Philosophically, that's not how I measure risk. Like, my risk tolerance is higher in the sense that not that I'm investing in crazy risky assets, but that I can tolerate year-to-year volatility.
Yeah.
I don't consider that a measure of risk for me.
Yeah.
For me, risk is a loss of permanent capital.
Yeah.
And so if the market meaningfully falls, I can wear that knowing that it will recover, knowing that I'm working a job and earning income and that I'm dollar cost averaging into indexes, but also stocks that I want to buy at different times. And so that's why I took gold out of the portfolio, because I was like, I don't feel like it's really serving a purpose for me and how I invest and how I think about my goals and my time horizon. Why did you sell it?
Exactly the same reason.
Yeah.
Just I felt the money could be better served elsewhere, and I for exactly that reason don't need it. Yeah.
If you do want to have gold in your portfolio, there's a age-old debate between, do you buy physical gold or do you buy gold miners? And there's no right or wrong answer, but I would say that for the purpose that we spoke about today, as gold in your portfolio, you probably want to lean towards physical gold. And the reason being that if you buy gold miners, you generally get more upside. When gold is going well, the gold miners sort of, there's like a little bit of leverage there. Like if gold goes up 50%, the gold miners might go up 80%, 100%. Like, so that, and that's why some people like gold miners. But the opposite is also true. If the overall stock market is falling, these gold mining stocks will likely fall as well, just because like the overall market is falling. And so then it's not really playing that counter-cyclical role in the portfolio. So that's just my 2 cents. People argue both sides of it. There's no right or wrong answer. It's just what you want out of your investment. And my final thought, if you do want to invest in gold, is there are ETFs that invest in physical gold and there are ETFs that invest synthetically to track the price of gold. Go under the hood of the ETF, look at the issuer's website and find one that actually holds physical gold.
Nice. Well, thank you for the question, Daniel. And if you would like to submit a question to the show, head to equitymates.com/contact. And there's plenty of options there for you to leave questions for us, for our advisors, submit to Pimp My Portfolio, give us a stock recommendation, industry deep dive, suggestion, you name it, it's all there. So hit us up and make sure you sign up to our newsletters as well to stay up to date with what's going on in markets and business. Link in the show notes. Well, Ren, absolute pleasure to chat stocks as always. We will pick it up next episode.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.